since I was 23. Absolutely love every piece of it. Super excited to be here for you guys to listen to today's webinar about tax strategies, and passing it over now to Matt to begin. And hopefully you all have a lot of questions. Feel free to post it in the chat or come up, raise your hand, and we'll get to one of you at a time.
Great. Well, thank you for the introduction. I really appreciate the opportunity to speak with you guys today. And I'm glad I've heard some people are excited about tax planning strategies. Can be kind of a dry topic even though I'm a CPA, it can be a challenge to liven it up a little bit. So hopefully I will do a little bit about that, a little bit on that. So as Tiffany and Carla mentioned, I'm Matt Ritzesender. I'm a tax partner at VSH CPAs. I have an extensive background in working with real estate investors and in the industry in general. Here's my contact information if you need to if you want to connect with me on LinkedIn or email me after the presentation. Next slide. Or 2 slides, I think.
And just so you guys know too, this is meant to be an active conversation. So at any point, please feel free to raise your hand or put it in the chat if you have any questions, and we'll get to your questions as soon as we can. If not, more than likely throughout the deck, Matt will most likely have already addressed it. If not, we'll make sure to circle back by the Q&A session.
Okay, thank you. I forgot that. So. Well, today I plan to cover 8 key topics: tax classifications, planning personas, because they're different, qualified business income deduction, depreciation, cost segregation studies, tax deferrals, incentives, and some of the other provisions that relate to real estate investors under the new big beautiful, oh my, OBA is what I think I'm going to call it. The new tax bill that just came out. I'll give you some of that. There's quite a bit more detail in the overall bill, but I tried to at least insert some of the most relevant tax provisions that will relate to real estate investors. And then I also put in a slide on Washington state taxes. There has been some recent changes, so I felt like it would be applicable for anybody that's a investor in Washington state. So, great. Okay, so the tax classification status. This is the first topic that I plan to cover because there are different types of real estate investors, and each one can be taxed differently. And generally speaking, real estate investors fall into 3 different buckets. There's passive investors, there's developers, and then there's real estate professionals. And as I mentioned, the reason why it's so important is because it impacts how the income and losses are taxed, when they're taxed, when losses are deducted. So when I'm working with real estate investors, the first thing that I typically do is I determine if the rental income is passive or non-passive, which is the term used by the IRS. And understanding this is critical to the overall tax planning strategy of that person. For example, it affects the deductibility of losses, whether net investment income taxes is applicable, qualified business income deductions. There are a few concepts that are important to real estate investors. You may hear it if you were working with a CPA or been in the business long enough, where there's a term called material participation. And the reason why it's important is because rental activities by their sheer nature are defined as passive activities, unless you are a real estate professional or you put substantial time into that rental activity. And the reason why it's important is because in many situations, it benefits individuals to be non-passive investors, because the income is no longer subject to net investment income tax, along with it when you sell as well, typically. And then you can deduct losses more immediately. I don't want to get into too much detail, but material participation just basically says you spend a lot of time. If you spend more than 500 hours on a rental activity, that's the easiest test to qualify. But in reality, it's a 7-factor test that are measurements. You kind of have to go through the scenario to figure out whether or not which tests you may or may not qualify for. You can look back years. The second term is a real estate professional. These are individuals like real estate agents, developers, people that do work in the real estate business full time. This test is a little easier as far as it's more black and white and less subjective. If you spend more than 750 hours in a year and more than 50% of your business relates to real estate activities, trades, or businesses, you'll qualify as a real estate professional. So if you're a real estate professional, most activities are considered to be non-passive. You can do planning around what they call grouping elections to optimize your income and make sure that it's taxed most favorably. So, okay, that was a lot.
I have a poll here, a quick question after this one.
Perfect.
For everybody, so I'm going to go ahead and launch that. So if everybody can take a moment to answer real quick, which tax strategy are you most interested in learning more about today, given some of the overview right now of what Matt had gone over with the agenda? Perfect. Wow. Looks like a lot of folks are interested in depreciation and cost segregation and green tax incentives. All right, I'm going to go ahead and end the poll so that everybody can see the results. All right, Matt, this is the consensus of the group here.
All right.
I know that you're going to be going over that with us later on in this deck, right?
Yes.
Perfect.
It's one of the first that will come up. I think it's further down. We'll touch heavily on that. That's good information to know.
Okay, perfect.
Tiffany, can you go to the next slide? The next slide is kind of more of the same. It's really the profiles of each kind of real estate investor. Sorry, next slide after that. These are the common types of investor profiles that we work with. There's flippers. There's your kind of your traditional developers, contractors. There's investors that do long-term holds. So think rentals, residential rentals, commercial rentals, multifamily. And then there's kind of the family LLC owner. Usually that profile is a person owns their own building and they rent it back to themselves. So that's what we call a self-rental. And there's some planning strategies and optimization and favorable laws around self-rentals. So some of the common tax structures that we come across or plan for, LLCs tend to be the number one or the most common, I would say, for anybody that's holding a long-term rental. The reason being is it offers flexibility and it allows for losses to be deducted more easily. So we can move things around more easily for whatever planning, like things that will come up is, let's say you have a couple different properties, insurance or the loan or the bank doesn't like having multiple properties in one LLC. LLCs have great flexibility. You can move them around. You can optimize things there. S corps are typically used for your developers and your flippers. That's mainly to limit self-employment income and still offer the protection of a corporation. And then LLPs, those tend to be your syndications and larger developments. They're your managed investments. And you will see other types of real estate, like joint ventures kind of might fall under LLPs or might be similar to the structure for LLPs for larger investments. I've seen those as well. We generally don't want long-term holds or rental properties in corporations for our smaller investors. It just isn't a good strategy. On to the next slide for QBID on rental income. I know this isn't the highest priority, but I'm gonna ask it anyways.
So we have another poll here, just right before we go into QBID here. The question would be, which of the following best describes your current real estate investment activity? That way Matt can have a pulse of kind of like the audience we have today. Oh, it looks like we have a developer, we have real estate professionals. Most are actually passive investors, and others are just getting started. We do have an active investor today as well, too. All right, so I'm going to go ahead and end the poll and share the results so you can have an idea of the what the audience encompasses of. So have quite a
Perfect.
few passive investors today.
Yeah, that's great. Well, we got a variety, so I think that's great for all the topics that I kind of plan to cover. Let's go to the QBID slide. I think it's two from here. So qualifies business income deduction. If you're not familiar with it, this is a deduction that small business owners, people that have structured their businesses as S corps, partnerships, self-employed individuals. It did a 20% deduction off of business income. And so it's a pretty substantial deduction. It came out under Trump's first tax reform, so about 8 years ago. And why is it applicable to rental income and why am I even speaking about it? Well, rentals are, like I mentioned before, aren't necessarily considered businesses per se, but in all circumstances. But when it relates to qualified business income deductions, it can qualify. And in most situations, it does qualify if you're an active investor. So if you manage your own property, if you rent to yourself, self-rentals, the requirement is that you're active in the rental. So if you're managing it, it most likely will qualify unless it's a triple net lease or if it's unimproved land, which is specifically excluded because there's just no involvement really necessary with those types of rentals. So if you're managing your rental, you should be looking at some of the safe harbor rules, whether or not need to aggregate the rentals with other rentals to make it an active rental and a business so that you can qualify for this deduction. We do a lot of our planning around the aggregation, and aggregation means you indicate to the IRS that I have 10 rentals, each one of them in itself, I barely participate in. But if I combine all 10 of them, oh wow, that's all I do. That's my business. I manage 10 rentals. And so you can get all of that income to qualify for this deduction. I think I saw a question come through. Let me
Yeah,
see.
Matt Jones has a question. Why is a triple net lease an exception to Cupid?
Yeah, a triple net lease basically uh basically you don't have to do anything. You would need some other facts and circumstances to get the rental to qualify. On its own, it doesn't, because you don't have to pay property taxes, you're not paying the insurance, you're not having to manage the property. Really, your lease is pushing that all on to the lessee. So your involvement in it is going to be very minimal. So they excluded that. Okay. The next slide, which I think is getting down to what everybody cares about most, is depreciation and cost segregation studies. I'm just going to start off with kind of the general lives of rental properties or real estate in general. So a residential property, if nothing else is done, is depreciated over 27 and a half years. Commercial or non-residential property or buildings are depreciated over 39 years. We have land improvements at 15, and then kind of the personal property within the building is 5 to 7 years. One thing to note on this is under the new tax bill, that energy efficient property, the 5-year life will be terminated. And I don't know the effective date of that, but I believe it's, I don't know if it's 2025 or 2026. I can get back to you if anybody cares about that. So I kind of give you this slide because it really impacts the next slide on cost segregation studies. If you go to the next slide, that would be great. So what is a cost segregation study? Just by a show of hands, does anybody know what a cost segregation study is? I don't think we had a poll for this, Tiffany. So I don't know if I'm going to be able to pull this off. I think there's a raise your
Yep,
hand
you can
button.
raise your hand using the icon on the bottom of your screen. It's real quick to see. Raise your hand if you know what cost segregation studies is.
Oh, you have a few. Matt Jones. Feel free to unmute yourself.
I'm also a CPA, so I'm aware of what a cost segregation study is. I'm just here for learning from another expert in the industry. But if you'd like me to explain.
No, I mean I can go if you want to, you can go for it.
No. Oh. Okay. I mean, cost segregation study,
yeah.
we're talking about, it's in the name. It segregates the cost between the real property and personal property. And personal property under the tax code can be accelerated in depreciation with the big beautiful bill. We're back to 100% in 2025 in the first year, whereas real property has to go straight line over those years that you just listed, 39 or 27.
Perfect.
Thanks, Matt.
Think
Look,
you
we
can
got all the Matts in the world here talking about
yeah,
taxation.
exactly. Yeah.
So
Yeah,
for
so
the
as he
people,
mentioned, as
Matt, for the people that have never heard of it or have heard of it but still are trying to understand how can they benefit from cost segregation, can you explain that a little bit?
absolutely. So as Matt mentioned, The study itself dissects the building into its individual components. So it's breaking it apart, and it opens up the different buckets like 5 and 7 year property. And what happens is the buildings themselves, if their lives are 27 and a half or 39 years lives, they're not eligible for accelerated depreciation, meaning you have to amortize it over the life. But for property that has shorter lifespans, which generally it's personal property and land improvements, you can actually take depreciation in the first year after the law was passed, but it's more favorable. So things like appliances, carpet, countertops, the dirt work, utilities, using bonus depreciation, you can write that all off up front. So I have a case study that we did a cost segregation study on a roughly a $1 million building, and it yielded a tax deduction of about $240,000. So we wrote off about 24% of the costs in that first year. And in this case, the person was a real estate professional, which I'll get into later. And so we were able to wipe out a significant portion of his income for that year, with generating a huge loss. And so in layman's terms, what is the benefit? It increases your cash flow due to the immediate tax savings of the accelerated depreciation. So you may not owe tax for a couple of years. In a lot of situations, that is kind of what happens. It's a large enough deduction with 100% bonus, where it may just wipe out their tax for a couple of years. And that'll allow them to, in a lot of cases, people are stretching themselves to come up with the down payment. And if you add a substantial amount of taxes on the savings that they put towards that, it can be a real cash flow crunch for people. So a cost seg can really help them limit their taxes, at least for the first couple of years after they've purchased a building. And not all buildings are created equal. A stick building, a warehouse that doesn't have anything on the interior probably isn't going to yield a large deduction, but a multifamily residential building will certainly get you a great deduction up front and then kind of in between. So some of the key considerations when we do cost segregation planning for our clients is we always ask the question, how long do you plan to hold the property? The longer you hold it, the better the net present value of the cash flow or the overall savings of it is higher the longer you hold it. Are you a passive investor or real estate professional? If you're a passive investor, do you have other passive income to utilize losses and offset them? If anybody has questions on passive losses, I'm happy to go into more detail on that. But generally speaking, passive losses are not deductible until there's passive income. So if you have a rental that's generating a loss each year, you're not deducting that until there is enough passive income to offset them. So you're at a net zero with that, assuming the individual's adjusted gross income is above 150,000.
And if I may add on that, that's where a lot of times when we talk about multifamily real estate, why it's kind of like your bigger bang for your buck, right? Instead of your single family residence where you purchase one property, and when we try to do a cost seg, it doesn't really make sense because you only have very little appliances or carpet or things like that that could be depreciable. Whereas now if you have 100 units per se, and each one of those unit has those particular appliances that qualify, those are the ones that now you can add them up real quick. And, just based on the case study that Matt had shared here, typically on a multifamily property per se, I would say rounding way 20 to 25% of the property value is usually what is depreciated. And so now that gets passed on to the investors through the Schedule K1. And again, that's where Matt mentioned is the paper losses that you can write off against your passive income. And then, of course, there are other nuances if you're a real estate professional, which Matt will share with us later on, the benefits of that and how you can further apply that towards your active income.
Yeah, thank you. Thank you for sharing
I,
that.
I would say, just to add a little bit of fun here, I would say that getting those K1s, that's like the happiest negative number that you can receive, right? You receive thousands and thousands and it's all negative, but you're so happy about it because you're going to be able to offset that other income that, that you're having.
Yeah. Yeah, no, but I have a lot of clients that receive those happy K1s, and it's not like the business is going under. It's just that you get that tax deduction. So yeah. One other thing I wanted to note is when you're doing a cost segregation study, you can do them on self-rentals. And you would need to make like a grouping election to combine them to take advantage of the losses if the rental business is not, if you don't materially participate in that business. The only other thing that I'll point out is some of the risks, and I wouldn't say risks, but what will happen is that if you write off the building up front, or a significant portion of that building, is your cost basis in the property is going to decrease significantly. So if you were to sell the property within a quick time frame after you did a cost segregation study, your book equity, so the value of the property minus the debt, could be substantially higher than what your tax basis is. So why is that significant? You could end up with a paper gain that exceeds the amount of cash that you're going to receive. So if you've written off 25% of the building in the first year, but you have and your loan is still pretty high. For example, some loans don't have principal right away. You can end up in a situation where your tax basis is substantially less than what ultimately, so your gain will be substantially higher than the cash flow that is received from it, because you've taken so much depreciation up front. It's kind of a hard concept to explain. I don't know if I did the best job at that, but there can be what I call a phantom gain that can exist. Careful planning needs to be done on that. We definitely need to talk to your CPA to understand what your cost basis is. Other things that can impact it, which we'll talk about soon, is like, especially if you did a 1031. Sometimes those gains don't necessarily line up with what your equity in that property is. So if you ever go to sell, make sure you're in touch with your CPA so that you can understand the tax liability. And then hopefully you can do some planning to mitigate or defer it, which is my next slide. If you could switch to the next one. Did anybody have any other questions on cost segs?
That's also more of all the reason too, Matt, with, just to piggyback on that, not only should you be, I mean, these topics are very complex, right? And it's very nuanced depending on the different circumstances that you're in and your portfolio that you're working with. And so all the more importance of making sure that you have the right advisors in your corner, and not only just a CPA, but have somebody like what Matt mentioned is that if you're planning to sell, engage and you want to do a 1031 exchange, not only engage your CPA, but also engage a, QI. And I see that Christopher is still he's here. He's a 1031 exchange expert.
Hi,
So
everybody. Nice
definitely
to meet
reach out to
everybody.
him if you need somebody to assist you with the 1031 exchange, because it is also, again, in and of itself a different animal. So make sure that you have the right advisors in place, because everybody has different goals for you, but you have to make sure that they're all aligned. And or if you need lending, then that's another thing too. You got to make sure you get your lender involved, because Matt, as a CPA, his bottom line is trying to get you to not pay as much taxes as possible, but then the conflicting goal might be where the lenders is like, well, you don't make any money. So again, catch 22, always make sure that you have all the right advisors in your corner.
I actually have a question for Matt, if that's okay.
Yes, go
Go
ahead.
for it.
So Matt, really quick, if you don't do a 1031 exchange, because there's a lot of investors out there who don't know really the benefits. So that's why they have to consult with a good QI and a great CPA. So when you did the cost segregation, right? You said it was about $250,000 the first year. Let's say they kept the property for 2 years, right? They cost segged it, $250,000 the first year, and whatever else it is on the second year. If they were to sell it outright without doing the 1031 exchange, it's a 25%, right? Is the depreciation recapture that they have to pay off the top. That's the first thing that comes off the top on the taxes, right? So it'd be 25% of that 250,000 and 25% of whatever depreciation that they took on the second year, right? So that's a total of 25% depreciation recapture for those first 2 years if they sold it after the second year without doing a 1031, right?
So yeah, so that the depreciation in the first year under this scenario, 25%, yeah. So like, let's just say you bought it for $1 million and you sold it for $1 million. Let's exclude selling costs in this case. Yeah, you have a taxable gain of $250,000 right there. Just with no appreciation on the property, but you've written off a quarter of the building. So that is one of the negatives or the consequences. And if you did sell it after a year, your loan may be still 80-85% of the purchase price. So in that case, there's a spread between your actual cost basis in the property and the loan. So let's say you got 20% equity in the building, but your basis is 75%. You have a 5% difference between the deductions that you've taken and your actual true equity in the building. So the short answer is yes, absolutely. You have to recapture all that depreciation when you sell it. And so if you did a cost segregation study and you sold it the next year, it really wouldn't yield much of a benefit.
Yeah.
It also has the potential of, without planning, to generate ordinary income for that person, because it's reclassified some of the property away from what you were referring to, which is the traditional building depreciation recapture. So it can have a lot of consequences of doing a cost seg and selling it right away. That's why when we do cost segregation studies, we don't recommend them without a very lengthy conversation. What's your plan? What's your, what else do you got going on? How long do you plan to hold it? Now, the counter to that is, yeah, if they're going to 1031, that's a great strategy, because now we can avoid a lot of that tax under your scenario. It would be super helpful, and in a lot of other situations.
Yeah.
So yeah.
And Matt, the second part of my question is, so if then the investor decided to do a 1031 and talk with a reputable QI, exchange of resources, right? then they're going to be saving at least about 30 to 40% in taxes, which includes the depreciation recapture, federal, state, and the net investment income tax, correct?
Not in
Approximately.
all scenarios, but yes,
Yeah, so on a
potentially.
$1 million, on a $1
Yeah.
million gain that they had with their investment property, if they were to roll it over into another property, they're saving about $300,000 to $400,000 approximately on that $1 million gain, right? I mean, depending upon what the numbers you crunch, but that's approximately what they would be saving if they did a 1031. Right?
Yeah. I mean, like I said, it does vary based on that person's
Yep.
what I call their profile. But if so for example, Washington State doesn't have a state income tax. But if
Mhm.
you're in a high state income tax state, yes. If you're a passive investor, now you're subject to net investment income tax. So yeah, absolutely. There's a little bit of a spread, but for the most part, yeah, it's kind of what's going to happen for us, especially for people that have higher or live in states or where the real estate is located in a state that has income taxes,
Thanks, Matt. I appreciate that.
which is great because that's my next slide and my first topic on the next slide.
Almost as if we planted Chris in here just to tee us up.
That's a great segue into your next
Right.
slide.
I don't even know if we need to cover it now, but I'll explain kind of the mechanics just so everybody
Yeah,
can.
that's for the next time, right, Tiffany? That's a 1031 exchange presentation for next time.
Yes,
There we go.
absolutely.
Yeah. So one of the strategies that we use for we call them tax deferral strategies is a 1031 exchange. If you can go to the next slide.
Sorry, it went back. Yep.
And then basically at a high level, what you do is you sell a property and then you reinvest the proceeds into a new property. And there's the 1031 laws allow you to defer the gain on the original sale if you satisfy all the 1031 rules. If I go into a little bit of detail, so for example, you need to sell the property and buy the property within 6 months, generally speaking. There can be nuances. There's types of 1031 exchanges that are more complex and that can go beyond that. But generally speaking, there's some narrow time frames that you have to buy and sell. You have to engage a qualified intermediary, and then you can defer the entire gain as long as you reinvest all the proceeds from the original sale. And when I say proceeds, I will also, this is something that people don't always understand, is that debt, if debt comes into play with that, so whatever the change in the debt will also affect the cash proceeds and could trigger some tax on a 1031 if you don't reinvest everything. But generally, if you buy a property that's valued at the same or higher, you're usually safe unless the loans change dramatically. So it's a great tool for properties, especially ones that you've done a cost seg on. So always keep that in mind before you sell a property. Talk to your CPA, talk to a qualified intermediary. As Chris mentioned, there's substantial tax consequences. Okay, so the next one is opportunity zones. This is a less common and new provision. Do we have anybody other than Matt that's knowledgeable or that knows what a qualified opportunity zone is? I figured most people wouldn't know what this is, and the interesting thing is it's not specific to real estate, but an opportunity zone is it's a investment into an economically distressed community where under Trump's old tax reform, he carved out these communities or areas on a map that said if you invest money, we're going to offer some preferred tax treatment on these opportunity zones. So if you, the reason why I included it here is it pertains to both businesses and real estate. So if a business is located in an opportunity zone, it qualifies. If the real estate's located in an opportunity zone, it qualifies. So an opportunity zone is an investment that you need to is a entity that needs to be formed specifically for investing in an opportunity zone. So you have to create what they call a fund for it. And to qualify, you have to have a capital gain. You have to invest cash into the fund. And then you also have to improve or invest in the property or business. They call it a double down. So if you bought something for 500,000, they want you to invest $1 million to substantially improve a property, for example. Obviously, if you're constructing a building, it's a little different. So the reason why an opportunity zone can be a great tool is it first allows for a deferral on the original capital gain. So if you had $1 million capital gain, you can defer it for a period of time and not have to pay tax on the original capital gain. If you hold the property for 5 years, you get a stepped up in basis of 10%. So it will reduce that original capital gain by 10%. So that's the second benefit. But the real benefit that that my clients have gone for, and specifically my real estate clients, is that if you hold a QO, qualified opportunity zone investment for 10 years and you sell it before 30 years, you will have no gain on that second sale. So, you invest $1 million, you hold it for 10 years, it's now $2 million. There's no tax if you were to sell that property at $2 million. So it can be a very powerful tool. Some of the drawbacks are it's costly to administer. You have to set up several different entities to optimize the tax planning and administration of it. You have to have a specialized LLC agreement. There's additional tax complexities that are necessary, testing, etc. It's pretty complicated. So if you go for it, my clients that have gone for it, they've tended to make it a large investment, not just piecemeal, to fully utilize that. That's a complex topic. I don't have a ton of clients that are doing it, but it was renewed under the new bill and or extended permanently, I should say. So it might become more prevalent, and it can be used. If you're going through a scenario, you would be choosing 1031, or you might be doing a qualified opportunity zone. They kind of, you wouldn't do one or the other, or you wouldn't do both. Yes. So there's a different tool there. So now the next one is installment sales. What is that exactly? Basically, you sell a property and you're holding the contract. It allows you to recognize the gain over multiple years as you receive payments on the loan. So you can defer the tax over, a span of several years. But it also, instead of having a gain in 1 year and putting yourself in the highest tax bracket and incurring all these additional taxes that come out for being in a high tax bracket, it might be able to even it. And a lot of people that are in retirement or nearing retirement, it can be a good tool because their income might drop substantially. So it kind of evens out the tax brackets and rates. So you might be able to avoid some of the net investment income tax, higher capital gains rates. Downside is you hold the contract, so you have the default risk of being the lender. There's a charitable remainder trust. I won't really get much into that, but that's if you're doing estate planning. There's quite a bit of complexity on that. But anyways, what's most important is that you talk to your advisors and just what are your goals? You go through the scenario, what are your goals and how can we accomplish it? There are tools out there. What's best for you in your specific situation? You have to consider a lot of things like what's your profile? What type of property? Age comes into play in situations. It's an extensive process when you're doing planning around these large transactions. So, okay, let's go to the next slide. So the new bill. So a lot of the bill, I'll just say it extended, in the most part, it extended all of the prior laws. So people won't see a ton of change from the original tax reform, which we called TICJA, which was, during Trump's first presidency. So there's a lot of people that won't see a lot of changes to how they're currently being taxed. But I did want to bring up a few areas that are specific to real estate investors. And in the new bill, they created what they call qualified production property. And this is interesting because qualified production property is generally speaking, it's defined as a newly constructed building or acquired building located in the United States used for manufacturing of tangible personal property, agricultural products, chemical production, or refining qualified products. So like refining crude oil to gas, converting wood pulp into paper. The provision was in there to try to get more infrastructure in the United States to support U.S. manufacturing. I mean, that's highly publicized and with the tariffs and everything going on there. But the significance is you can write 100% of the building off in the first year, not the 25%. It's all. You can write off $1 million building up front. So that's interesting. It's new. I think it's got a 4 or 5 year lifespan from 2025 to 2029. As I mentioned, the opportunity zones have been modified but extended permanently. I have seen a lot of real estate investors use those tools. Section 179 depreciation. We didn't talk about it much here. Sometimes it's applicable to real estate investors, but it's a tool to write off assets or property up front. The reason why I included it here is sometimes we are able to use it for rental properties in some situations, but generally speaking, rental properties are operate in a loss position, which doesn't allow you to utilize all the Section 179 up front. Mortgage interest deduction limits were extended. So if you have a mortgage that exceeds $750,000, you can't write off the full amount of mortgage interest. And one thing that I didn't put on this slide, but I should have, that is super applicable to everyone, is the state and local tax deduction. That was a hot topic item. For the past 8 years, you've only been able to write off $10,000 of sales tax, state income tax, property taxes. They're all in one bucket, and the cap was $10,000. They've increased that to $40,000. So people in states with high income tax, this is really applicable. People that pay a lot of property taxes on their personal house, a second home, or you just live in a state that has high property taxes. You guys will be getting additional deductions for that. Yeah, okay, let's go on to the next slide. And I know this was a popular topic. I saw a few people that were interested in this, and which is great, but it's all phasing out under when I originally wrote this slide. This would have been a key slide. I probably would have put it near the front because the last tax law revision actually expanded a lot of these credits for people for energy efficient property in real estate. But under the new bill, they're all phasing out. So if you're going to be purchasing and installing any energy efficient property, you should get it done in 2025 to make sure that you're able to maximize the credits that are still available. I won't go into all the different dates because in a lot of cases they vary. Some are in the end of 2025. Some of them are halfway through 2026. So just talk to your CPA, especially for anybody that's doing a larger project that may qualify. Okay, let's go on to the next slide. I've got 5 minutes, so I will try to get through this quick. One more slide. Quick question. How many people are in Washington State? I actually probably see 3. Okay, so 3. Okay. Well, I'm in Washington State, so I put this slide in here. I won't cover it too substantially here, but in Washington, there was some recent law changes that negatively impact that people generally that hold real estate. So if you're a high net worth individual, there is a new law on Washington estate tax that was modified, and the estate tax rates have increased from 20% to 35%. They've changed the exemptions. The other thing to be aware of is they also have increased the real estate excise tax on any real estate sales. One thing that some people commonly don't know is that in the state of Washington, under our new capital gains tax, real estate is exempt. So if you're if you're having conversations, you don't have to worry about that additional tax. There was changes to our capital gains rate and how that's taxed. There's not a ton of people in here for Washington, so I'll just keep it at that. But the residency and the sourcing rules, it's just really important. If you own Washington real estate, it could be applicable, but real estate in Washington the values are so high that it's pushing people to have taxable estates in Washington. And that's probably across the nation. If you're in a state that has a state estate tax, be mindful of that because real estate values are triggering quite a bit of state estate tax filings. Okay. Sorry. All right. So last. So some of the key actions that we're taking for some of our clients is getting a cost segregation study done, especially now that the bonus depreciation rules were restored. If you're doing substantial planning and on a purchase or on a sale, definitely confirm with your CPA what kind of taxpayer you are. What's your status? Are you passive? Are you active? And that is a property by property basis. So it's not a cut and dry analysis. So it does take some time to understand that. So work with your CPA on that. As I mentioned earlier, act on any clean energy tax savings. Here's a few services that we offer to our to our clients that we come across in the real estate industry. We have an international tax department, so we'll help people with some of their foreign real estate. If it's owned by a foreign individual, there's additional filings required. Let's see here. Yeah, so I think I covered most of that. Ready. If you guys are interested in actually going through and listening to more detail on the new bill that just came out, for example, business owners or anybody that's curious, we actually have a webinar. I'm presenting a small piece of it tomorrow at 9 a.m. Anybody's interested in attending tomorrow to get more current information on the recent bill. It'd be more extensive and broad than just real estate. It's the whole bill. Yeah. Is there any other questions that anybody would have, or you can always contact me as well.
We also posted his contact in the chat as well. So if you
Okay.
have any other, we are at the top of the hour. Thank you so much, Matt, that we appreciate the information you provided. We've learned quite a bit. And if you guys have any additional questions, feel free to reach out to Matt and schedule a consultation with him, or if you have some opportunities that are coming up where you might have some, CPA type of questions, tax questions, and how the tax implications may affect you, definitely reach out to him. But just a quick heads up real quick before we hop off. We do host these type of webinars once a month, and our upcoming one is August, in August. And so stay tuned for that information. We'll send it out with the webinar information for it. It's going to go over AI, and our own Carla Cordovez is going to be going over the specific of how AI will impact our future investing. And so we'll definitely send you guys the information on that. If you want to learn a little bit more, obviously, most of you guys probably already have our information. If not, feel free to reach out to myself or Carla, and we're more than happy to schedule some extra time here to answer any questions that has not been answered. And last but not least, before you go, we at the end of the when we end the session, a survey will pop up, and we hope that you'll take just a 1-minute quick survey so that you can give us feedback on what your take is about this webinar and what we can do differently or better. That way we can ensure that we continue to deliver valuable, nuanced information for you going forward. So please do take a minute just to fill out the survey. Other than that, thank you so much, everybody. We appreciate your time. And we'll see you at our next session, August 29th, or is it 28th, Carla?
28th.
28th at 1 p.m. And then Chris, I'm going to follow up with you. We'll do a recrash course on 1031 QI in one of the subsequent months. And again, always trying to deliver value to you guys. So have a great day. Thank you all.
And
Thank you,
you.
Matt.